Okay, welcome back, everyone. So next up, we have our financials team. Zach Griffiths is going to moderate this panel, focusing on private credits and the linkages within the system. We have our newly minted co-heads of financials, Josh Esterov and Peter Simon. And then we also have a special guest, Meghan Neenan, who is from the Fitch Ratings side, who leads the non-bank financial institutions group. Lots of questions on BDCs lately, and she's quite the expert on that. So looking forward to hearing from her. And then Nick Moglia, who is our senior analyst covering REITs. Zach, I'll let you take it away.
Okay. Thank you, Winnie. Hope everyone got some refreshments, and thank you for this great crew of panelists for joining me up here today. As Winnie mentioned, we're going through private credit and trying to expose the linkages across U.S. financials. For me, I have two clear goals for this panel. I want to kind of trace the risks from the borrowers in the private credit market to the extent we can to the regulated financial system. That's what we have our co-heads of U.S. financials up here for, and Meghan to kind of give us that lens into the private credit market. And then CRE risk was something that we were asked about quite a bit over the past couple of years. My question now is it back of mind, or is it truly in the rearview mirror? And we're going to explore that topic through Nick Moglia's lens with REITs. So with those two goals, and we're going to leave you some key takeaways and investing themes for 2026 at the end. But I want to start with you, Peter. So you just did a great report looking at exposure of banks in your coverage space to the non-bank financial institutions. How much risk is building for the banks, and kind of how would you assess the quality of the exposure that banks have to entities like BDCs?
Sure. So that exposure is growing quite a bit. Just to put some numbers around it, the banks that we cover, the exposure to non-bank financials is about 16% of total loans now. Not all of that is private credit. Obviously, it's a number of different subcategories. The business credit portion that includes private credit is about 4% of total loans. But just to underline the growth, non-bank financial loans have been about a third of loan growth, or over a third of loan growth in recent quarters this year. So it's definitely punching above its weight in terms of growth. And I think for that reason, it's definitely worth paying attention to. But definitely some important context to keep in mind is where this growth is happening. So the vast majority of the increase in exposure to non-bank financials is happening at the largest banks. So it's JP Morgan, Morgan Stanley, Citi, Goldman. So this exposure is, it's growing at the largest and most diversified, best capitalized banks in the system. It's not really showing up as of yet in smaller banks. So that limits the concentration risk to a large degree. And just to put some numbers around that, at the largest banks, loans to private credit are coming in around 1 to 2% of tangible assets. So it's really difficult to construct a scenario currently where the losses on those types of loans are so large that it really creates a systemic problem. And then I would just take a step back, question whether this is an entirely new risk for the sector or just a change in the type of risk that they're taking. What I mean by that is that a lot of the loans that are ending up in private credit and in the syndicated loan market would have ended up on bank balance sheets in maybe decades past, but post-crisis regulations have pushed a lot of that activity outside of the regulated banking system. Talking mainly the leverage lending guidance in 2013, as well as the capital and liquidity rules from Dodd-Frank and the stress testing requirements had a significant impact on what type of loans banks are willing to put on balance sheet. So you could argue that exposure is coming back to the banks via loans to private credit, but I would argue that it's with a lot more protections built in than if the banks were to be doing that type of leverage lending or middle market lending and keeping that all on balance sheet themselves. And also worth pointing out that the loss rates on private equity and private credit lending historically are extremely low for the banks and lower than the rest of the commercial and industrial loan books. So if credit does turn, I think there's a decent chance that you'll see more losses in just the general C&I book than the non-bank book.
Well, that's exactly where I wanted to go next. Are you seeing a turn in credit quality? We've seen some high profile failures, fraud, whatever you want to call some of those instances. And I think there is a broad sense that some of that risk was covered up by some of the lending going on in the private credit market. But what are you seeing from the banks in terms of overall credit quality for the banks you cover today? Is there really a bunch of cockroaches in U.S. financials, or are these truly isolated incidents?
Yeah, that seems to be the word of the year. So yeah, I mean, like you mentioned, there were some very high profile failures. First Brands, Tricolor, a few others. The banks that we cover had very minimal exposure, very manageable exposure to these situations, but they did generate a lot of attention. These incidents were in the news at the same time that the banks were reporting third quarter earnings. So that gave us a much more fulsome picture of what was actually going on in credit for the industry. And we did not see any sign that in third quarter results that of a turn in credit, or that these incidents were a harbinger of a turn there. So credit still, if anything, credit still looks like it's on actually an improving trend. And it's important to keep in mind that there was a moderate weakening in credit in 2023 and 24 and then subsequently tightening of underwriting across the sector. So this year has largely been kind of stable to improving, and that's still where we are right now. On the consumer side, especially, we came into the year expecting improvement on the consumer side, and we've seen the last several quarters lower year-over-year delinquencies and net charge-offs in the credit card books of the large banks. There's been some concern about subprime auto, mainly in the securitization market, but that's not really a significant exposure for the banks, and also we're not really seeing that weakness generalized across the consumer books.
All right, so you're comfortable with the risk out there. If anything, it's improving. I think it gets maybe missed that there was some worsening a few years ago that we're coming out of. So, Meghan, from the perspective of the BDCs, and as I understand it, you've been covering BDCs for quite a bit longer than they've been quote unquote cool, if I can give it that title. How has credit quality evolved in the BDCs that you cover at Fitch Ratings? Are you seeing broad deterioration that would suggest maybe what we're seeing in the regulated bank sector is a lot different from BDCs, or are you seeing more similar trends?
Yeah. The short answer is no. There's nothing that's broad in terms of deterioration there, but I think the theme of the last 2 years really has been around differentiation. So, interestingly, just in terms of background, Preqin actually put out their forecast for 2030 through 2030 for private credit. They included BDC assets in that forecast for the first time. So, if you take BDCs plus direct lending, you're about $1.5 trillion of assets. BDCs are about a third of that book. And BDCs are a good window into what's happening more broadly in direct lending, because lots of these platforms have multiple BDCs, they have direct lending funds, they have SMAs. And so they just internally syndicate these deals across those different pockets of capital. So there's a lot of overlap kind of between those different buckets within the Preqin forecast. So what we saw, if we look at non-accruals, for instance, it's not as great as what you see in the banks. It's not regulated. Non-accruals have some subjectivity to them for sure. But non-accruals on a cost basis for the 32 BDCs that we rate publicly were 2.3% at the end of September. That compares to 2.4% at the end of 2024 and a 5-year average of 1.9%. On a fair value basis, which is what we tend to focus a little bit more on because that has a direct impact to kind of equity and leverage, it was 1.1%. That compares to 1% at the end of last year and a 5-year average of about 0.9%. So that all seems pretty flat. Ares Capital Corporation has been around for over 20 years, which has been rating BDC since 2005. If I looked at the last 15 years for Ares Capital Corporation, who tends to be a bit more conservative in how they book their non-accruals, 1.4% on a fair value basis non-accruals. Their non-accrual rate at the end of September, 1.4%, right? So pretty stable. If we look at losses, which is harder to manipulate,
losses or net realized losses through the first 9 months of the year, 60 basis points. That compares to 1% for all of last year, and 40 basis points is the 5-year average. So that doesn't seem like it tells much of a bad story either. Differentiation, though, is what I mentioned kind of to begin with, right? So on a non-accrual basis, the range is 0% for some, which is certainly unsustainable. But on a fair value basis, that caps out at 4.6%. So that's FSKKR. You also had TCPC at 3.9% and 3.2% for OCSL, which is Oaktree Capital. So those, not coincidentally, are 3 BDCs that we took negative rating action on in 2025. So there's definitely been differentiation. You've seen the same thing on a realized loss perspective. So gains, 1.7% for New Mountain, all the way up to losses of 6.4% for BlackRock TCP. So differentiation, definitely key. As we look at next year, so there's definitely some positive things going on. The economy seems like generally okay, but also the bigger thing is that these are floating rate loans. Rates are coming down, so debt service should improve. So that's a good thing in terms of credit performance and how we think of it. We do think there could, credit losses next year will kind of be flat to maybe modestly up, but I think differentiation is what you're going to kind of continue to see. One of the things that we definitely focus on is just platform, size of the platform. What is your access to deal flow, but also what is your ability to work out these deals? BDCs, some of them are very large. Some of them have 35 people. If you have 35 people, you're working things cradle to grave. You probably don't have a separate workout function. And Ares Capital Corporation does have a separate workout function. So if you look at their losses over the history of their existence, 10 basis points or less for first lien loans, 20 basis points or less for second lien and subordinated loans. So really good track record and really good ability to kind of work those out over time.
All right, so I'd say that's more of a similar story to what we're hearing from Peter. A lot of these metrics are mostly in line, maybe not improving right now, but kind of within an average. And so I think another one of the big questions that we get from the private credit risk perspective is how it's showing up on insurance investment portfolios, in their investment portfolios. And Josh, I know you and I do a regular podcast looking at your review of the investment portfolios. As I understand it, private credit has been growing immensely. Are you concerned from your coverage space just how much risk these lifers and P&C portfolios are taking in private credit today?
Yeah, it's a good question, and it's a very popular question. And I don't necessarily know that I would use the word concerned, but it's certainly worth a high level of scrutiny, especially when you contextualize it with some other factors. And, I think what I'll do here is I'll kind of set the table a little bit with some stats and then maybe do a little compare and contrast with what Megan and Peter had just talked about. But to set the table, on regulatory filings, what's reported as private investments is about 1.8 trillion on life insurance balance sheet. So that's obviously a massive sum. Now, that accounts for about 30% of overall insurer investment portfolios. But if you narrow that down to just the regulatory definition of bonds, which is largely like corporate credit and ABS, it's closer to 50%, which is a very high number. But to be fair, about half of that is fairly generic 144A. But regardless, all of the growth really has been in private credit over the last, 10 years or so. So like private as a percentage of the total investment portfolio said it was 30. That's up like 10 percentage points over the last decade. And I'm not really 100% sure where the stopping point is. So Peter was talking earlier about how a lot of that is perhaps concentrated in some of the best capitalized, most diversified banks. In insurance, that's not necessarily the case. Everybody is forced to adopt these private credit strategies, whether or not necessarily they have the in-house capabilities or expertise to do so. We're seeing an increasing number of insurers partner with asset management firms. By way of example, one of the more prominent ones in the very recent past was Lincoln National and Bain, taking a 10% stake there and a significant portion of the asset management operations to drive their private credit story. So insurers have this enormous incentive where they have to compete with the private equity funds, whether or not they have a private equity partnership of their own. And you also are in this moment of time whereby insurers are really able to boost, their current investment returns on assets that were added perhaps during a portion of the interest rate cycle that was like best described as anemic, versus now where it's obviously substantially more favorable, and you're bolstering the returns with less liquid assets, which insurers theoretically are supposed to do. Peter had mentioned earlier that, the strength of the consumer was still good. Another kind of aspect of that where I agree is that insurance premiums have been very strong. Premium generation has been very strong this year, which puts more money to work. I know you were mentioning earlier that the retail team doesn't necessarily agree. So I think Peter and I are going to do like a boxing session against the retail team to kind of resolve this consumer weakness or not once and for all. But point being, high level of scrutiny, especially, contextualized with other factors like the elevated use of private letter ratings, all the insurers kind of moving into the private credit space in a very kind of compressed period of time. So to date, the strategy has performed extremely well because we've been in this like super benign portion of the credit cycle, but we'll see.
All right, so not to put words in your mouth, but I feel like that's part of my job as the moderator. Maybe you're a little bit more concerned, even though you just said concern might not be the correct word, about how this is kind of infiltrating the space and maybe a strategy employed by some insurers that are a little bit less able to deal with issues if we were to see them down the road. Now, Meghan, I feel like what you went through and the lens into private credit that we have so far is everything looks pretty good. Everything looks fine. What are you looking for? I know you kind of went through some of the non-accrual metrics in terms of early signs of red flags, and you kind of mentioned the interconnectedness of the ecosphere of private equity, private credit. We can bring in insurance and the banks. Is there anything from that lens? What are the early signs of red flags that you're keeping an eye out for?
Yeah, I mean, I think, we've just gone through a pretty tough environment in terms of M&A activity. So a year ago, really, you saw a lot of spread compression. And aside from a blip around Liberation Day, spreads have been tight. And so M&A and volume hasn't been that great until very recently. So then the question is, what are you competing on, right, if it's not price anymore? So then you start to think about what's happening with underlying leverage, terms and conditions, covenants, and all of those things. And so we do get, even though BDCs tend to be relatively transparent, they're SEC filers and they have a good amount of information in their filings, there's still not a lot of information that's consistent across the board in terms of, their underlying portfolio company metrics. So we do get that from them on a confidential basis. Leverage has certainly, if you go back to kind of GFC to today, leverage has certainly ticked up over a very long period of time. But to Peter's point, part of that was changes in regulation and things. And so, and just with some of the banks being in and out of the market, people have gotten more comfortable with private credit solutions over time. And so now you see the line between broadly syndicated and private credit really blur. So naturally, you've seen the underlying EBITDA amount that private credit is involved in increase significantly. I mean, Ares, I think their weighted average is over $300 million in terms of the portfolio companies that they work with. So some of the things that we think about is, if you're looking at where are they maybe taking more risk in order to offset some of that spread compression, is there yield differentials across the BDC universe that maybe indicates you're taking more risk? We have not seen a lot of BDCs kind of move down market in terms of, there's not a second lien really market to be had today. And in that, the stuff that's out there we've heard from BDCs is not very attractive. But we do see the creation of like off-balance sheet funds and JVs to try to kind of juice returns a little bit. But I won't say this is the story of the day because this has been the story of the last couple of years, is just PIK, right? So I think that's been a warning signal for some that they tend to be very focused on. Through the first 3 months of the year, paid in-kind income on a gross basis is about 8.1% of interest and dividend income at BDCs. So that's double where we were pre-COVID, and this is going to be the 6th year of it kind of ticking up on an annual basis. I think the range for the 32 that we cover is 1.6% up to 18%. But then even with that, you have to dig in a little bit more on good PIK, bad PIK, I think is a media term, the terminology that's been used. So now with so much competition in the market, you have PIK that's structured at origination, there's PIK toggles, and that's really just a competitive tool and maybe a juicer for returns. So that's kind of deemed good PIK. And then you have amendment-related PIK that's deemed bad PIK. There are not a lot of disclosures around what that breakup is between different BDCs. You have an FSKKR who's disclosed that maybe it's 50-50 for them. I think that's a bit high for the sector at large. Ares Capital in their investor day last year talked about, the 18% or so that they have as a percentage of their income. It's only about 1.6% that's amendment related. So that seems pretty low. But certainly PIK is something we're definitely keeping an eye on. And I think competition is going to continue to mean that we need to be looking at these underlying metrics. Peter mentioned to start too, the leveraged lending guidance that's been rescinded. right? So just within the last couple of weeks. So I think that's a big question is, what does that do to bank activity? How much more competition does that bring back into the space relative to private credit? And then on the margin, what are we looking at in terms of terms and conditions being pressured even more? The good news is M&A seems to have legs. I think that'll be certainly positive in terms of competition and helping that. But we're continuing to see money flow into the sector, and Preqin is certainly looking for considerable growth coming from private credit over the next 5 years, so that's not going to slow.
I'd say a doubling of PIK, that sounds certainly interesting and maybe a good leading indicator. So setting aside the private credit discussion, it seems like from our panelists that's not going to topple the financial system in 2026, at least. One of the big questions, as I mentioned at the outset, CRE. Nick, I want to bring you in. What are you seeing through the lens of REITs in the CRE space? I feel like office has been the problem child since COVID. Kind of take us through your views across the various property types so that we can kind of fit that into how it fits into risks to the global or the broader financial system.
Yeah, sure. So I would say over the past year, we've seen a pretty gradual improvement in CRE fundamentals overall for most of the traditional property types. And we're kind of expecting more of the same to occur in 2026. I think a factor to consider that kind of solidifies this view is the fact that CRE transaction markets have pretty much formed a bottom now. And in recent months, we've actually seen an improvement on both pricing and volumes. And, to the extent we have the Fed expected to cut rates 1 to 2 times next year, I think that's only going to help solidify our view here. And so with that being said, we're constructive on the sector overall. With that being said, there are certain sectors we like more than others. So, heading into next year, we're mostly constructive on senior housing and on retail. With senior housing, you have just very strong demographic trends that are playing out across the U.S. with the over 80 population expected to grow around 5% annually over the next 5 to 10 years. So you just have a very solid baseline level of demand growth there. Within retail, we think demand for brick and mortar is pretty, solidified even amidst the growth of e-commerce. And, the key fundamental point to, just consider for retail is the fact that the supply pipeline for retail real estate has been very minimal for numerous years. And that's expected to be the case for the near term. So we kind of like the fundamental backdrop there as well. Another sector we like is multifamily. It's a little bit more of a contentious view just because the Sun Belt has been dealing with a lot of oversupply pressures in the past couple of years, sorry. But we think 2026 is expected to be more of a turnaround year for the multifamily names. If you just look at the overall supply pipeline for multifamily overall, construction and permitting activity is down around 30% versus peak levels. And then you have just a demand for apartments that remains, fairly resilient. I think that's partly because the housing market remains a little bit shaky at this point, and also because you have very strong demographic and migration trends happening across the U.S. Sun Belt. So we think all those factors considered is going to be more of an inflection point for 2026 for, improved fundamentals for the multifamily names there. And then shifting gears to, a couple sectors we're a little bit more cautious on heading into next year. This includes office and life science. I think within office, it's important to kind of differentiate between the premier and non-premier office assets that are out there. I think demand for office is, gradually improving amidst the backdrop of, hybrid and remote work. And what we're seeing is now a lot of large tenants kind of enacting return to work mandates and whatnot. But a lot of those large tenants are basically looking to be in kind of the best in class, highly amenitized, well-located, in your commuter hub assets. And that obviously tends to favor, some of the premier workforces out there. So just a couple of data points to kind of hit on this bifurcation. You have net absorption for, premier office that has been a positive 10 million square feet over the past 3 years versus negative 5 million square feet for the rest of the market. You have vacancy rates for premier workforces that are kind of in the low teens area versus high teens, low 20% for the broader office market. Then you have asking rents for, the office, premier office that's in the $90 to $100 per square foot area, which is around 50% above the overall market. So, a couple of key data points that's just really highlighting the clear bifurcation that's happening within office. We don't see any signs of this slowing down, at least near term. So if you were to get any exposure to the office space, this kind of has to be in like the, premier, best in class names out there. So that includes a name like BXP. And I can talk about them a little bit, but, that's kind of how we're viewing the office space overall. And so I would just conclude with, to the extent we have, again, the Fed expected to cut rates next year, we're pretty constructive on the REIT space overall. We are market perform on the sector. This is mostly a valuation driven view. The sector's trading 80 bips over, which is in line with overall corporates. We think that's fairly priced. We don't really see a lot of upside from here. But overall, REIT credit quality remains very strong heading into next year. I think investors should be a little bit more, selective in terms of the property types I just discussed. And then I would just conclude with, to the extent there is a very large wave of CRE debt maturities coming due over the next 1 to 2 years, there may be certain borrowers out there that may not be able to refinance and are forced to sell off assets. We think the REIT names are in a great place here to kind of pick up on any incremental M&A opportunities that may arise from this fallout. And they certainly have the balance sheet strength to do so.
All right, so I'd say that's a pretty rosy picture overall. You kind of started the comments by saying we found a bottom, a lot of bifurcation, talking about these asset types in one broad stroke. I think is not the correct way to do it, but I think that's a great way to break it down. Peter, I want to go to you. I'm not going to ask you to tick through each space from the bank balance sheet perspective, but how does Nick's view that we found a bottom and we're starting to see some improvement fit with your view of the CRE lending books within the banks that you cover?
Yeah, no, what Nick said definitely tracks with what we're seeing in bank credit quality. We haven't really seen much stress outside of office, even in 2023. It was really all focused on that one area. The other asset classes seemed healthy, and we're starting to see some improvement even within office. So while there's been stress in the last few years, the banks have those exposures are well reserved for at this point. And we're actually starting to see some reserve releases. So to the extent that CRE was one of the drivers of that moderate weakening in credit in 2023-24, it's turned the corner into improvement. And we're actually hearing banks have been shrinking CRE exposures as far as on the loan book in recent years. We're actually starting to hear banks say that they're comfortable starting to grow CRE loans again. So I think that also kind of confirms what some of the positive fundamentals that Nick was talking about.
All right, so we're well aligned there. I think one of the other big things that stuck out to me, Josh, when we did our podcast a few months ago, was your comment on just how much the insurance investment portfolios have also been taking greater mortgage exposure. I think most of that was residential, but maybe take us through, again, through the lens of kind of CRE and real estate broadly. How are you thinking about that exposure for the life and P&C insurers on the investment portfolio?
Sure. So I think there's actually a little bit of a disagreement
All right.
from the perspective of the insurers versus these pesky REITs, banks, and stuff like that. But really what we're seeing is kind of this interesting development where, first of all, office is just totally persona non grata within insurer mortgage lending portfolios, for example. So that's going to be a non-starter for them for the foreseeable future. They got a lot of work out still to do. They've extended a ton of these maturity profiles. They just don't want any more exposure to that sub-asset class. They are taking exposure in retail, and they are taking exposure in housing. And then the housing aspect, I think, is really interesting, and I'll talk about that in a second. But to give you some numbers, mortgage lending is like $800 billion for life insurers. That's like 15% of the investment portfolio. That's probably up like 3-ish% over the course of the year, but kind of under those numbers is commercial mortgage lending has been basically flat. It's been residential mortgage lending, which is only like 15% of that $800 billion number, but that's doubled over the last 2 years. And so this is an asset class that insurers once functionally ignored and yet are now on an aggregate basis increasingly adding allocation. But what's also interesting is that it's being driven by just a handful of names. And you may not be surprised to find out that I'm coming back to the private credit story. I'm coming back to the private equity names like KKR, Apollo, translating to Global Atlantic and Athene. That accounted for like 50% of the industry growth in residential mortgage lending over the last couple of years. And in some of the conversations that I've had with actually a number of insurers, they intend to kind of copy that strategy just the same way that they copied some of the pioneering in the private credit space that was going on. So this could perhaps be a new source of a new kind of, not new, but emergent asset class that the insurers once ignored.
All right, so we went through private credit from a variety of perspectives. We hit on CRE relatively briefly, but it sounds like things are improving there as well. So I feel like we've highlighted a bunch of reasons why financials should be in good shape going into 2026. But I want to circle back and see if there are any risks that we're missing. Meghan, I want to start with you. You mentioned that you've already taken some negative ratings action on some of the have-nots in this bifurcation of haves and have-nots that you think is kind of underway within the BDC space. Take us through your views as we look ahead. Are you expecting to take any ratings action? Your overall outlook for the ratings risk within the BDC space next year?
Yeah, we have a deteriorating outlook on the sector for 2026, which embarrassingly has been in place for a number of years for different reasons. But, competition is certainly continuing to drive that, but so is rates. So these are floating rate portfolios, and these BDCs have REIT tax structure. So they have to distribute, at least 90% of their earnings on an annual basis. And so as earnings go down, then their dividend coverage goes down, and we expect some dividend cuts to come through as well. There was also some mention of just maturities, lots of debt issuance in 2020 and 2021 coming out of the pandemic. So they did a good job managing debt maturities this year, but 2026, you're going to see the peak in terms of debt maturities in the sector. I think they've gotten ahead of that, but there could be some issues with funding flexibility for some of them if they're needing to kind of shift to secured financing to refinance some of those. That being said, from a rating outlook perspective, that is stable. So we have 32 BDCs. We have 2 that are on positive outlook at the BBB level and 2 that are on negative outlook at the BBB minus level. And those are FSK and Oaktree, which I mentioned before. And so, I think that we'll continue to see rating differentiation. That's the goal. When you have 32 and a lot of them are BBB minus, we want to do our job and help people kind of to discern what the risk is. And so I think that will continue to develop. The other risk that I might mention, though, too, is that these perpetual BDCs, you see a lot of semi-liquid products that have been created over the last number of years. You have the 401k issue, right? In terms of that being a big TAM or total addressable market that these alt managers are certainly looking at. Blackstone created the first perpetual BDC in January of 2021. So you're just at the point where you're hitting 5 years of seasoning. And so I think we'll start to see what that means from a normal kind of cadence of redemption activity. And so I think that could have some, potentially liquidity risks or contagion risks to other sectors, just depending on how we see those redemptions play out over time. There's nothing signaling a big issue, but we did have the Blue Owl decide to kind of back off on one of their mergers, and that has certainly led to some headline risks. So whether or not there's, a follow through in terms of redemption activity or any contagion in other BDCs, I think is a wait and see.
Yeah, I'm glad you brought up that Blue Owl. I feel like people are pointing to that as a potential canary in the coal mine. So that's kind of an interesting way to set us up for next year. Peter, I want to go to you next, bringing this all together, kind of going through our risks. I feel like we have this regular consumer call where we kind of discuss trends, and you're always the most positive one in the room over the past few months. Maybe take us through your favorite ways to position in your space for 2026.
Yeah, so we still have an outperform on the banks. Still view it as a positive fundamental story, not just from credit being stable as I discussed, but earnings there's a lot of tailwinds right now. So mainly from fee income. Capital markets have really helped revenues. So net interest income is also being helped by lower funding costs. There's some offset on the asset side, but it's a good environment. The stable to declining rate environment is a good environment for bank funding. And then you have some technical tailwinds as well in terms of the SLR reform that was just released also included a reduction in the debt requirements at the large banks. So I think given where spreads are, and we're still positive fundamentally on the regional banks, but don't see as much value as we used to in that space as we would have, maybe a year or 2 years ago. So given the technical tailwinds and the fundamental tailwinds from that capital markets activity that's expected to continue into 2026, we like the large banks relative to the regional banks. But given where spreads are, I think it makes sense to concentrate on higher quality names within the space.
All right, up in quality bias, that certainly resonates with us on the strategy team. Josh, I want to go to you, kind of take us through your favorite ways to position, maybe your top picks, and it'd be interesting to get your perspective on if we're wrong and we are going to see a meaningful deterioration in private credit, in BDCs, whatever it may be. maybe consider who's most at risk.
Sure.
Space.
Yeah, I like the second part of the question a lot better than the first.
Okay, we'll go with that one.
Yeah. So, if your base case assessment is that there is something to the story that, private credit risk, for example, is at least somewhat systemic in nature, and it's not what we've seen in the data so far that suggests that, perhaps it's been more idiosyncratic in nature. But if that is your kind of thesis and how you're thinking about the next year, and that we're going to exit this more benign portion of the credit cycle, what I'd be looking at is some of these insurers that perhaps do not have what I consider a little bit more of like a first mover advantage, that they were among the pioneers in the space, or at the very least, they have the sophistication and the capabilities to do some more of this in-house. It's the insurers more so playing catch up with some of these other institutions in order to get their investment portfolios to approach the steady state that they want in the foreseeable future. So they're not getting the first pick of assets. And, perhaps they're relying on a partner, or perhaps they're relying on relatively new capabilities in-house. And if you were to pair that potential risk factor with certain insurers that perhaps have unrelated operational challenges, well, now you only need kind of like one or two events to happen, one of two events to happen in order to kind of create an underperformance story. So like names that could be included in that, earlier I had mentioned like a Lincoln National, just playing catch up from a private credit perspective, and they're only a couple years removed from like some major operational challenges. So any further hiccups there could lead to outperformance. So it's insurers like that I'm a little bit more worried about if your thesis is that we're going to, approach some kind of inflection point in the cycle for private credit. So it's the tier 2 names, I think, that I'm a little bit more worried about. Where I'm very much aligned with Peter is up in quality, I have very limited concerns. So if you're looking at some of the industry leading names like a MetLife or Prudential, a Chubb, those kind of names, unless they go out and I feel buzzing in my phone. So unless Chubb just bought AIG, I'm less concerned about those names, those types of names. That's kind of where my head's at.
All right, Nick, I want to go to you. You kind of mentioned in your earlier comments, do you have a market perform on the sector? There's a little bit of valuation and fundamentals in there. Maybe take us through your favorite names in the space.
Yeah, sure. So just to rehash the property types we like more than others, most constructive on senior housing, retail, and multifamily next year. Within those names, we like Ventas and Welltower. Those are two very large healthcare REITs with very large exposures to senior housing. So we like the fundamental setup for those two names there. For retail, we like Kimco and Simon Property Group, two very large portfolios that have very stable balance sheets. We're outperforming on both names, and this despite the fact that both names actually got one-notch upgrades recently from the rating agencies. We still like the backdrop there. And then for multifamily, we like UDR Inc. It's kind of smaller multifamily name that is high BBB rated, but they're offering 10, 15 bips of spread pickup versus overall high BBB REIT peers. And around half their portfolio or so is Sunbelt focused. And again, with our favorable view on Sunbelt heading into next year, we think this is kind of a turnaround story for that name. And we do see signs for spread compression for that, for UDR. And then for the other sectors, again, we would avoid anything within office and life science at this point. And then we're pretty much neutral on self-storage and industrial. We like the fundamentals there, but there's just not a lot of attractive valuations for either of those sectors. So,
awesome. All right. So we covered a lot. We looked at the financials landscape through the lens of private credit and CRE. We've got a few minutes for questions. We want to hear from you. What did we not cover with this great panel up here that you want to hear more about?
Peter was hoping for a lot of questions, so let's go.
Nothing at all.
All right.
All right. Well, thank you all. Thanks to our panelists. And we are going to go right into our next panel on the consumer snap, crackle, or pop with James Goldstein, Jim Dunn, Dave Bussey, and Todd Duvik. Thank you.
Thank you.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.